Hello everyone, welcome back to the course Strategic Management Accounting. Topic 4, Strategizing Management Control. As we discussed in the previous lectures, there are three interrelated domains or sites of strategic actions in which strategies are enabled and enacted differently: the market, point of production, and the organizational hierarchy. In the previous lectures, we discussed that how a particular position in a strategy can be enabled and enacted in the market. So in creating such a position in a strategy in the market, there should be a strategic connection between the market and the point of production. That means the point of production or the factory and the labor processes should be able to produce and deliver what the market demands. And then the organizational hierarchy, in a very broader sense, should provide the necessary control infrastructure to make sure that this strategic connection between the point of production and the market is maintained. So in this lecture, our attention is on the organizational hierarchy. How we can enable and enact strategic controls within the hierarchy so that a viable strategic connection between the point of production and the market can be established and sustained. So our discussion on the organizational hierarchy, how strategies are enabled and enacted within the organizational hierarchy, is divided into two topics. The first one is strategizing management control, that is this topic. And the next one will be strategizing performance management. So in this topic, our attention specifically will be on how management control is strategized in the recent past. In doing so, we will first have to have a broad understanding of what we mean by management control and why controls are necessary and how we enact and enable various control structures, processes, and systems. Accordingly, the first theme of this particular topic will cover the classical definitions and frameworks of management control, which mainly concentrate on operational aspects, operational dimensions of management control. In other words, management control in the sense of operational control. And then we will revisit these classical understanding of management control to see how management control is strategized in the recent past. For that purpose, we will pay our special attention to Simon's levers of control framework. So, as a learning objective, after following this particular lecture and after reading the recommended readings for this topic, you should be able to explain management control in its classical understanding as an operational control element. And then the second learning objective, you should be able to explain how this conventional management control understanding definitions have been reconceptualized as strategic management control with special reference to Simon's levers of control framework. Let's start with the most fundamental questions. Why do we need controls? And what do we mean by controls in a very generic, broad sense? Such a generic, broad understanding of control is critical for our further exploration of how management control was strategized in the recent past. In a broader sense, various forms of controls are necessitated by contradictory conditions. It is the contradictory conditions that necessitate various forms of controls, including management controls. And such contradictions, such conflicts can be conceptualized at various levels. For example, such conflicts and contradictions can be conceptualized as wider global macro-political contradictions. For example, between nations or between various global entities. In that sense, the control has to be conceptualized, designed, and implemented at a global level as global governance, global regulatory infrastructure, and global controls and so on. Or such contradictions may be conceptualized as a contradiction between various parties involved in a market transaction. So at that level, when we are thinking about the contradiction at market level between various parties involved in market transactions, then the control will be conceptualized as market regulations, market governance. Or the contradictions and conflicts may be conceptualized as the contradictions and conflicts between various subsystems of an organization. For example, between production, marketing, and human resources. In such cases, we talk about management control systems to mitigate the contradictions and conflict between various organizational subsystems. Or you may think about the contradictions and conflicts as interpersonal contradictions, interpersonal conflicts. So in which case, you would design and conceptualize your control system to mitigate such interpersonal contradictions and conflicts. Or at its very, very micro level, you may even think about the contradictions and conflicts as intrapersonal, psychological contradictions or conflicts taking place within a person. So at that point, you would be talking about self-control. So the notion of control can be understood very broadly, depending upon the specific contradictory condition in reference to which you are thinking about your control systems. So therefore, it is the conditions of contradictions and conflicts that necessitate and define the control systems, which can be very broad, global level contradictory, regulatory or governance systems, or very micro organizational level contradictory conditions, necessitating management or the operational control systems. Or it can even be rather intrapersonal, psychological contradictions necessitating what we call self-control mechanisms. And then, the manner in which we design and implement and conceptualize controls and control systems pretty much depend on the way we conceptualize the contradictory conditions. And the way we conceptualize the contradictory conditions depends on the alternative theoretical or conceptual frameworks that you may use. For example, if you use a system theory in a very broader sense, you would see the most fundamental contradiction is between the external environment of an organization and the internal organizational dynamics. Therefore, the contradiction that you want to mitigate is the external environmental and internal organizational contradiction. So in that sense, you may define and conceptualize and design your control system as a system through which you mitigate the contradiction between the external organizational dynamics and the internal organizational factors. And on the other hand, if you use systems theory in a very narrower perspective, then you would conceptualize organization as a system constituting a set of subsystems. And then you conceptualize the contradictions between various subsystems. For example, between techno-managerial system and the human system of the organization. So you would design, conceptualize your control system as a system to mitigate these possible contradictions and conflicts between the techno-managerial system of the organization and the human behavior or the human system within the organization. Or, if you use, for example, Marxist framework, then you would think about the contradiction between the capital and the labor. For Marxist, the fundamental contradiction is between the capital and the labor. Capital tries to exploit the labor with the maximum efficiency possible, and the labor resists. So, management control is necessitated to mitigate this contradiction between labor and capital, so that labor can be subordinated, labor can be subsumed for the interest of capital. That's how you see management control if you are a Marxist. Because for a Marxist, contradictory condition is defined as the contradiction between capital and labor. And in a very similar fashion, but with different terminology, agency theory would conceptualize the contradiction as something between a principal and an agent. The principal wants the agents to behave in a particular manner to maximize the principal's interest, say shareholders' wealth. Whereas the agent would be motivated by his or her own interest. And the agent would be facilitated by and framed by opportunism, greediness, and information asymmetry. And this contradiction between the principal and agent, this conflict of interest between the principal and agent, is considered to be the agency problem. So if you are using an agency theory framework, management control systems are there to mitigate this agency problem. And alternatively, you might think about management control systems as a particular set of operational controls where you are trying to mitigate the contradiction between the organizational policies and the individual employee motivations and interest. So you would think about management control as operational controls by which you make your employees comply with a specific set of rules, regulations, and so on. So that's how you can think about management control differently, depending upon the specific theoretical framework or a conceptual framework you might be using. So in a broader sense, controls are necessitated by contradictory conditions. And controls can come into being in so many different ways depending on the particular contradictory condition for which the controls are designed and implemented. In that sense, Controls can be very macro level, broad systems, regulation and governance systems, or it can be market level systems to control the behavior of people involved in market transactions, or it can be organizational level systems, or interpersonal systems, or even intrapersonal systems of self-control. So that's what we mean by control in a very generic sense. Any means that we put in place to mitigate a given contradictory condition. Now, let's talk more specifically about management control systems. According to, for example, Emmanuel, Otley, and Merchant, management control is the totality of the processes by which a system adapts its internal behavior in response to the changes in its external environment. It involves the gathering of information to regulate and monitor activities to ensure that some desired outcome is obtained or a desired state of affair is maintained. So that is the famous definition given by Clive Emmanuel, David Otley, and Kenneth Merchant. And in a very similar fashion, Anthony and Govindarajan defines management control as a process through which the organization's management attempts to ensure that the organization adapts to the changes in its substantive environment in a fashion that the behavior of all members of the organization is consistent with the behavior required to implement the organization's strategies and achieve organization's objectives. That is the famous definition given by Anthony and Govindarajan. Both these definitions in common identify that management control is a process. And that process try to manage the tension between the external environment of an organization and the internal dynamics of the organization. So that is the primary contradictory condition that the management controls attempts to mitigate. And in doing so, management control should ensure that all elements of the organization, including people, its divisions, groups, and even machines, would perform, would behave, would carry out their activities in a fashion that comply with some desired behaviors or desired outcomes, desired activities, and so on. So in other words, the actual need to be in line with a certain desired state of affairs. So accordingly, management control as a process would involve 4 key elements. The first key element of management control is that we should have a clear definition of the desired state of affair. Which could be, for example, goals, objectives, strategies, and so on. Or it could be more specifically some set of standards, targets, norms, rules, procedures, laws, and so on. So that is the first element. We need to have very clearly defined a desired state of affair. And in a very broader sense, these desires are spelled out in so many different ways, including goals, objectives, targets, standards, budgets, rules, procedures, and so on. In other words, there should be a certain set of higher order principles which everybody in the organization should follow, which everybody in the organization should try to achieve, and which everybody in the organization should demonstrate. So that is the desired level of outcomes, behaviors, and so on. And then the second element of the control process is that we should measure, understand, conceptualize the actual condition, actual state of affairs, the actual behaviors, actual outcomes, actual activities carried out, and so on. So that is the second element, the measurement, understanding, seeing the actual, observing the actual. So we have a knowledge, information about the actual, so that we can monitor, we can regulate, we can govern, and we can control the actual in line with the desire. So that is the second element. Then the third element is comparison between the actual and the desire. So once you know the desired level, for example, in terms of a standard, and then you have to measure the actual and then compare the actual with the desire. So that the comparison is the third element of control. And then the fourth element is, if necessary, after this comparison, we have to take corrective actions. If the actual is not in line with the desire, then we have to take the corrective actions to bring the actual in line with the desired. So those are the key elements of a control system. The definition of the desire, measurement of the actual, comparison of actual with the desired, and then taking corrective actions when the actual is not in line with desire. The management control process can be further explained by using the notion of cybernetic, which Norbert Wiener defined as the scientific study of the control and communication in the animal and machines. Since 1970s, accounting scholars such as E.A. Lowe, Ansari, Otley and Berry drew upon various notions of cybernetics to explain management control systems. Now, according to the cybernetic understanding of control, the system that we are going to control, for example, an organization or a machine or a department, need to be conceptualized as a system which involves or which constitute three key elements: inputs, process, and outputs. So that is the first principle of cybernetic. Cybernetics conceptualizes the system to be controlled as a system of input, process, and output. Such a cybernetic system interacts with its environment in two fundamental ways. The first, it takes input from the environment. Then, inside the system, that input will be converted, transformed into output through a process, conversion process. And then that output will be provided to the environment. So the input and the output is the two stages at which the system would interact with the environment. And within the system, there's a conversion process. So the cybernetic goal is to collect the input from the environment to make sure that this input process is continued without any problems. And then finally, to provide the desired outputs to the environment. If the system is unable to provide the desired output to the environment will start to reject the system, and the environment will stop providing input anymore, and the system can't survive. So in a cybernetic system, is highly dependent upon its environment. And the cybernetic objective is therefore to maintain and sustain the support that the system gets from its environment. And for that, there's an input, process, and output elements in the system. And then controls can operate in three different forms. The first form of control is directed at the input. We call it input controls or feed-forward controls. And the second form of control is directed at the process. We call it the process control or concurrent control. And the third form of control is directed at output. We call it output control or feedback control. So that is how a cybernetic conception of control conceptualizes the system that is to be controlled as a system which depends on its environment on the basis of receiving input and providing output. And in between, there is a conversion process. And accordingly, there are three forms of control to regulate, to monitor, and to control these three key elements: input control, process control, and output control. And such a controls, whether it is input control, output control, or a process control, can be or should be carried out with the help of what we call a predictive model. So according to this diagram, which is originally designed by Berry and Otley, the predictive model occupies the very center of a cybernetic framework of control. The predictive model provides a particular conceptualization of the manner in which input, process, and output are connected to each other. How inputs is converted into output. So that is in a desired way. So that is what the predictive model does. It conceptualizes, it measures, it provides a broader understanding of the specific manner in which the input, process, and output are connected to each other. For example, a standard costing system is a predictive model. A standard costing system should define and explain how various raw materials are mixed together, combined together, used by various forms of labor, skilled labor, unskilled labor, grade A labor, grade B labor, and so on, using standard times and using standard amount of raw material and other elements in the conversion process to produce a particular amount of goods and services. So there are standard output. To produce a 1 unit of product A, we should use, say, a certain element of raw material A, raw material B, and raw material C, and a certain amount of or certain hours of labor and overheads and so on. So we have a specific measurement, specifications of the way we have to use our raw material, our labor, our overheads, and so on. So standard cost for a given amount of output. So that's the predictive model. And similarly, our budgeting system is a predictive model. So we have various budgets related to input controls. For example, labor usage budget, material usage budget, and so on. And then we combine them together in a specific manner to come out with our master budget, profit and loss account, and the budgeted balance sheet. So we know, therefore, if we want to achieve a particular target profit, budgeted profit and loss account, or a balance sheet, we need to have these levels of operations, this level of material usage, labor usage, and so on at the input level and the process level. So that is a predictive model. And this predictive model plays a very centric, critical place in the cybernetic model. So because if you get this predictive model wrong, the whole controlling process could be wrong. So that's why the cybernetic people say control is communication, control is information, control is knowledge. And the predictive model provides the basis upon which that communication, that knowledge, that information is created. And you gather information about the input, process, and output according to the predictive model, according to the manner in which predictive model defines the input, defines the process, and defines the output. And if you think about this predictive model in terms of the 4 key elements that we discussed about management control earlier, the predictive model defines the desires. The predictive model establishes the desires. Our targets, our budgets, our goals, our standards, and so on. Not only that, the predictive model provides the measurement, the basis upon which we can actually measure the actual performance, actual behaviors. So even the measurement of the actual behavior is carried out according to the specifications given by the predictive model. So this predictive model, therefore, not only establishes the desire, but provides the conceptual basis based upon which we actually measure the reality. The amount of input that we used, the actual process that we used, and actual outputs that we have achieved. And then, according to this cybernetic model, we compare them. That's the third element. A comparison is done with or in between the desire given by the projective model or predictive model and the actual behaviors we measured. And then the cybernetic model will provide a signal about the difference, deviations. For example, in a standard costing system, we ultimately understand, we label each variance we calculate as a variance, adverse or a favorable variance. If it is an adverse variance, then we have to take corrective actions. In that sense, according to cybernetic framework of management control, the controls takes place in 4 different ways. The first form of control is called first order control. That is the input control. So when or if your comparison between the actual and the desired output, so you compare your output, actual output, with the desired output, and if you see that there is an unfavorable deviation, a deviation or a variance to be corrected, then first form of correction may be you have to correct the input. If you understand that your output is not achieved at the level of desire because there was a problem with the input, in which case you correct the input. That is the first order control, input control. The second reason for this deviation, this variance between the actual and the desire may be nothing to do with the input, process, or output, but actually our target, our predictive model, our objective is not acceptable, too high, not achievable. So in which case you have to correct not the actual input, process, or output, but rather your objectives. So you correct your objectives, you amend your objectives, and that is called second order control. And if you think your input is okay, still you can't achieve your output because there is a problem in the process. So you need to redesign the process. You want to reinvent the process. You have to correct the process. You have to modify the process. In which case, the correction or the control is directed toward the process, and we call it systemic learning. According to cybernetic jargon, terminology, we call it systemic learning. And then you understand this deviation between the actual and the desire is mainly because of a certain fundamental errors, problems, or mistakes taken place in the predictive model itself. It is nothing to do with the input, not the process, not the output, but our predictive model, our standard costing system, our budgeting system got something wrong here. So in which case you direct your changes, direct your actions towards modifying the predictive model, and it is called internal learning, redesigning the predictive model. So that is how we understand management control according to cybernetic principles. So in brief, the cybernetics understand any system that is to be controlled as a system of input, process, and output. And such a system would depend on the environment on the basis of its input and the output. And to control this cybernetic system, we have to direct our controls towards input, process, as well as output. We have input control, process control, and output control. And to do that, we need to have a predictive model. A model or a conceptual frameworks according to which we understand the connection between input, process, and output. And that is the framework according to which we have specific measures to measure the actual performance of this input, process, and output. And in that sense, the predictive model provides both the desire and the actual, which we have to compare in taking the corrective actions. So the predictive model provides the basis upon which we measure the actual, and we understand the desire, and we compare the actual with the desire. So once we understand that there is a deviation between actual and desire, we have to understand why that deviation. If that deviation is related to the input, then we have input control mechanisms, input control actions, which we call first order controls. Or the deviation may be simply because of miscalculation of objectives, misunderstanding of objectives, and in which case we direct our control actions toward the amendment of the objective. That is called second order control. In some cases, the deviation between the process output and the desired level of output may be due to certain problems in the process. So in which case we direct our attention toward the process, and we call it systemic learning. And finally, so this deviation may be basically because of a particular conceptual error in the predictive model, in which case we redesign the conceptual framework or the predictive model. We call it internal learning. Robert Anthony provides a useful classification or a hierarchy of organizational control systems: operational control, management control, and strategic control. If we relate these three forms of controls with the three interrelated domains or sites of strategic actions that we discussed in our previous lectures: the market, the hierarchy, and the point of production, then operational controls operate at the level of the labor process, the point of production. The operational control aims at synchronizing the labor with the productive machine or the productive system. Operational controls aims at mitigating the tension between the techno-managerial demands of the productive system and the human elements such as motivation, interest, capacities, capabilities, skills, and so on. So that is the primary aim of operational control: to synchronize the labor, the employee, with the productive system. For that purpose, operational controls may use techniques such as standard costing, specific standards about use of raw material, labor, and so on, operational budgets, rules, procedures, and regulations, and so on. So the operational control techniques will specify to the labor how, when, and to which outcomes a particular activity should be carried out. For example, in producing a particular unit of output using a particular machine, the operational controls will specify how many units of raw materials to be used, how many hours of labor to be utilized, and so on. So that is operational control, operating at the point of production or at the level of labor process. Then management control is related to the hierarchy, our second site in which strategies are enabled and enacted. So in that sense, management control try to mitigate the tensions, contradictions between various elements of the organizational system. For example, between production, marketing, and human resource management, various departments, various divisions, and so on. So the management control is located at the level of hierarchy, at a middle management level perhaps, or in between top management and middle management, to coordinate, to consolidate, to synchronize the activities and outcomes and performance carried out by various divisions, elements of the organization as a whole. And for that particular purposes, we may use still various management control techniques such as balanced scorecard, functional budgets, master budgets, ratio analysis, DuPont system of ratio analysis, and so on. And then strategic controls operates in the market or the competitive terrain. The strategic controls try to mitigate the tension or the contradiction between the external environmental dynamics and the internal organizational performance, outcomes, and the factors. So in that sense, strategic control is to ensure that the company as a whole can meet the pressures, demands imposed by the environment, especially the competitive terrain, competitive markets. For that particular purposes, we may use various forms of strategic controls, which we will be discussing later on in this lecture. With that broad understanding of organizational control systems, We are now in a position to discuss certain strategic imperatives or strategic dynamics of management control systems using Simon's levers of control framework. According to Simons, the most critical strategic tension or contradiction that a firm should manage is the tension created by two strategic imperatives or dynamics. The first one is the dynamics of value creation, and the second one is dynamics of control and regulation. These two dynamics or strategic imperatives pull the firm in two directions, creating a tension between them. The dynamics of value creation demands the firm to be creative, innovative, flexible, change oriented, and risk taking. In order to create value, the firm should expand its operation, launch into new areas of technologies, new markets, and new products, making huge investments. For that end, the firm has to be creative, innovative, flexible, and change oriented, and take risks. At the same time, the dynamics of control and regulation demand the firm to concern about its operations, regulate it, control it, monitor it, minimize the risk, maintain a pattern in actions so that it is easy to control the direction in which the firm moves. The firm should not be exposed to too much risk. The firm should not be expanding too fast so that it can't control itself. For example, a classic example is the Enron case, which we will be discussing in our tutorial classes. In the case of Enron, you will understand that Enron expanded very heavily. Enron was creative, innovative, change-oriented, very flexible, and high risk-taking company until it collapsed because it couldn't control itself. It couldn't regulate its employees' behaviors, and it quickly jumped into certain areas of operations in which it can't manage itself. It took a too much risk and ultimately couldn't survive. One of the largest firms in the world suddenly collapsed, creating a huge global scale financial crisis. So that explains the strategic necessity of creating a balance between these two dynamics. Dynamics of value creation on the one hand and dynamics of control and regulation on the other hand. In that sense, the functional role of strategy formulation and strategic control is to manage this strategic tension between the value creation and control by creating a set of managerial processes so that these structural or strategic tension are given due attention in the short run as well as the long run decision making processes and information flows. So that is the functional role of strategic management control system: to mitigate, to balance, to manage the tension between these two opposing dynamics of value creation and dynamics of control and regulation. For that end, Simon proposes a framework constituting 4 key levers or pillars of control. And the strategic management control system should be designed, conceptualized, and understood as a system that would constitute these four key pillars or these four levers of control. The first pillar of control or lever of control is the boundary system. And the second one is the belief systems. And the third one is diagnostic control system. And finally, we have interactive control systems. And the first two, those two levers indicated at the top of this diagram, the belief systems and the boundary system, represent the dynamics of value creation. So those are the two pillars or levers through which we manage the dynamics of value creation. And then the bottom two levers, the diagnostic control systems and the interactive control systems, are the two levers through which we manage the dynamics of control and regulation. In this overall context, in this context of four levers of control, the strategy needs to be understood in multiple sense. The strategy needs to be understood as a plan so that we can enact diagnostic control systems. So we formulate the strategy as a plan to get the things done. So it is the diagnostic control system. So there we might have various standards, budgets and so on, balanced scorecard and so on, through which we diagnose the control problems, through which we establish our desired level of outcomes, targets, budgets and so on, and then we measure our actual behaviors and do the comparisons and take the corrective actions. And then simultaneously we have to have an interactive control system. That is where the strategy works as a pattern in action. That is to make sure that the people's behaviors are patterned in such a manner so the firms can be regulated in an ongoing manner, in a continuous sense. So the behaviors, actions that the firm and its members carry out by itself create a particular regulatory pattern, a particular control structure. So that's a pattern to things that we do. So we do not want to deviate very heavily from those already established patterns in actions. So all the expansions, all the changes, all the movements, innovations, creativity has to be linked to this gradual movement of pattern. So in that sense, we see strategic management control as creating pattern in actions. And then the boundary system. In the context of boundary system, we have to understand strategy as positioning. The boundary system would define the specific boundaries within which we have to operate, within which we would invest, within which we would expand our activities. So that defines our area of risk, our territory. Set up the territory in which we would operate. So that is strategy as positioning. What would be the specific terrains, domains, market segments and so on in which we should operate. And then we have belief systems. The belief system is strategy as a perspective that answers the question how we would carry out our activities, how we would do our things in that particular terrain. So the boundary system defines where we would operate. And the belief system define how we would operate in that particular system. Our ethics, our values, our beliefs, our corporate conduct, and so on. So this is the overview of Simon's levers of control framework. So to summarize, Simon's levers of control framework provide a particular conception of the strategic management control systems. And according to that framework, the most critical strategic tension or contradiction to be managed is the tension between two dynamics of value creation and dynamics of control. To manage, to mitigate this tension between these two dynamics, we have to conceptualize and design the strategic management control system to constitute 4 key pillars. The boundary system, which defines the boundary within which we should operate, and the value system, which defines the manner in which we should operate in that boundary. Our ethics, our values, and our culture, and so on. And then diagnostic control system, which defines the strategy as a plan and which enable the company to diagnose, to assess the actual behavior of the company, actual performance of the company and its members and its elements against the desired status of affairs. The classical, usual management control systems that we discussed previously. And then finally, we have interactive control system. So that is the control embedded into the manner in which we carry out our activities as a set of actions which evolves over time. So we have a pattern in action, historical movement, that provide a particular control element to our own behaviors, to our own directions. So out of these 4 levers, the first 2 levers, boundary system and the belief systems, relates to the dynamics of value creation. And the next 2 levers, diagnostic control system and interactive control system, relates to the dynamics of control and regulation. So ultimately, the functional role of a strategic management control system is to mitigate, to manage the tension between these two dynamics with a proper mix of these key pillars or key levers of management control. So that's what Simon tells us. Now, with that, we have reached the end of this lecture and this topic. So this topic was about strategizing management control. So this topic was organized around 2 main themes. The first one is the classical understanding of management control, which we discussed in terms of control as mitigating contradictory conditions, control as a process of designing the desired outcomes, measuring the actual behaviors, comparing the actual with the desire, and taking corrective actions. Then we further expanded this discussion using cybernetic control model. And then we also discussed Robert Anthony's classification of management control or organizational control into operational control, management control, and strategic control. Then finally, we dealt with the strategic dimensions of management control using Simon's levers of control, which in a broader sense identify 4 key levers which should constitute the strategic management control system in order to mitigate the tension between the dynamics of value creation and the dynamics of control and regulation. Thank you very much for following this lecture, and see you again in the next lecture.